When I bring up the topic of retirement planning with my clients, I get a lot of pushback, and understandably so. I mean, it's quite stressful to think about what's going to happen in your retirement, much less have to worry about something that may not happen for many years down the road. But at what cost? So I get asked pretty frequently, what is the right age to obtain a retirement annuity? And I'll address that in a future video with respect to the different types of annuities. I also get asked, well, why not wait? I mean, interest rates are historically low right now. Why not wait until interest rates go up? Well, by the end of this video, I'll give you a better understanding of what the cost of waiting is and why you need to invest in your retirement and your retirement planning today. In my next video, I'm going to actually demonstrate to you what that cost of waiting is and how impactful it can be on your retirement portfolio. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. Retirement annuity advice. Subscribe to my YouTube channel and hit that notification bell so that you can receive notices anytime I post a new video. To start off, let's address whether the interest rates are going to go up and if you should wait to invest in a retirement annuity until the interest rates go up. So I thought it was interesting right before I started the video, I saw an article that the Federal Reserve Chairman Jerome Powell reported that the short-term interest rates were going to be held near zero. So that's as of today. But just to give you some perspective, so the 10-year Treasury note is currently hovering around 1.6%. So the Treasury rate on the 10-year note was 15.5% near the end of August 1981. And we're now near 1.6%. And that's 40 years of decline. So how fast those interest rates will go up? Who knows? But I can say that according to, again, the Federal Reserve Chairman Jerome Powell, they have no intentions of raising the interest rates until we reach our goals on maximum employment and inflation. So inflation has gone up, and they have acknowledged that inflation has gone up, but they think that's going to be a temporary event. So we may be dealing with low interest rates for many more years to come. Again, who knows? And now we're back to the question, well, I've got a few years to wait for retirement, so why not wait and see what happens with the interest rates if they're going to go up? Well, have you heard of the cost of waiting, which is actually the title of this video? So it has something to do with the fact of $1 today is worth more than $1 tomorrow. And why? Because you can actually invest that dollar today. It's referred to as time value of money or compound interest. So compound interest is where you earn interest on interest. And I'm going to demonstrate with an example in my next video. Leave me a comment in the section below and let me know when you think the interest rates will be on the rise. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and don't forget to hit the notification bell so that you can receive notices anytime I post a new video. So interest rates are not very compelling. I just mentioned that they're hovering around 1.6% for the 10-year Treasury note, and that the Federal Reserve has no intentions of raising those interest rates anytime soon. So is compounding interest really that significant? Well, let me tell you, even though I will show you in my next video how significant compounding interest can be, that there's another cost of waiting, and it's those invaluable mortality credits. So your income paycheck for your lifetime income annuity actually consists of 3 parts. That would be principal repayment, interest, along with those mortality credits. And the older you are, the more your income paycheck is going to consist of those mortality credits rather than a principal repayment and interest. So what exactly are mortality credits? Well, when you sign up for a lifetime income annuity, the insurance company pools your money with others in the same age category as you. So those mortality credits are the excess payments that are left behind when other annuitants in your age category pass earlier than expected. Just to clarify, you're not paying an additional cost to receive those mortality credits. And one of the reasons why you cannot calculate a return on a retirement annuity is because you don't know what that return is going to be until at the time of your passing. And by then, it really won't matter. Now, here's where the cost of waiting kicks in with respect to mortality credits. Even though you're assured to receive those income benefits month after month from your retirement annuity, and maybe even for a lifetime if lifetime income, mortality credits are not assured. So given that we're dealing with improvements in medical technology, research, and advancements to cure diseases such as cancer or kidney disease, just to name two, we're living longer. And the longer we live, the less of a pool of mortality credits that's available to annuity holders. So lock in your mortality credits today. So what are the trade-offs for waiting to purchase a retirement annuity? Well, let me explain what it's not. It's not putting your money into CDs, money market funds, and savings account that's earning you close to 0% interest. So at the beginning of the video, I mentioned that the Federal Reserve has no intentions of raising interest rates anytime soon, and they're even keeping the short-term interest rate at near 0%. That's not helping your CDs, your savings accounts, or your money market funds. But is that money accessible? Well, pretty much so, yes. I mean, CDs, you can get them for a pretty short term to make them more accessible than say a multi-year guaranteed annuity, where you're going to be hard stretched to find a term of 2 years. They're mainly 3 years for a multi-year guaranteed annuity. And I do feel like that's what's holding people back from obtaining a fixed annuity, is the fact that their money is locked up in that contract. And it could be for several years, or it could be for the entire period of the contract if it's irrevocable. Do note that there are some provisions that do enable you to pull out some money during the term for your retirement annuity, and I will talk about that in a future video. But bear in mind why you're purchasing that fixed annuity. So you have to know that that fixed annuity is what you want from your retirement portfolio at the time that you sign that contract, and why you're obtaining it for your retirement portfolio. And it's for that lifetime income, money that you cannot outlive in your retirement. And as I noted in a previous video, that's one thing that an annuity can do that no other product can do, assuring you that you cannot outlive your money in retirement. If you're interested in obtaining retirement insurance in the form of a fixed annuity for the financial security, certainty, and happiness it can provide in your retirement, click the link below to apply to become my client. Also, if you enjoyed this video, don't forget to like this video, subscribe to my channel, and hit the notification bell so that you can receive notices every time I post a new video. Also, be sure to share with your family and friends. Thank you for watching. Let's get the conversation started on how you can live your best retirement while not outliving your money.